Welcome to Safe Option Strategies presentation of fundamental analysis. This class is a production of Safe Option Strategies and the content is protected by copyright. Any reproduction or redistribution of this or any Safe Option Strategies presentation is strictly prohibited by law. The information presented in this class is for education purposes only. Safe Option Strategies does not make any recommendation to buy or sell stocks or options. Trading stocks and options comes with risk and you are solely responsible for any losses you may incur as a result of trading. So the whole premise of fundamental analysis really boils down to one simple thing, and that is the importance of doing your homework. I am a huge believer as we get into trading stocks and options. I have become over time, I wasn't always this way, but I have become over time a huge believer in knowing the companies you trade and trading the companies that you know. Knowledge is power in the stock market. I firmly believe that. The more you know about a company, the better an educated guess you're going to make. The reality of trading stocks and options is this. Every move we make, every time we buy a stock, every time we sell a stock, every time we buy an option, every time we sell an option, every time we open a spread trade or close a spread trade, every time we place a trade or make a move in the market, we are making an educated guess on what we think the price of that stock is going to do. That's all. It's nothing more, it's nothing less than that. Well, it could be, I suppose it could be less than that, but at the best, we are making an educated guess. Does anybody here, does anybody listening to me in the live presentation, or think about this if you're listening to this as a recording, do you know what the stock market is going to do tomorrow? Do you know if stocks are going to go up or down tomorrow? Pick any company, pick any publicly traded company in the U.S. Do you absolutely, unequivocally, with certainty know what that company is going to do tomorrow? Do you know what it's going to do next week? Do you know what it's going to do next month or next quarter? If you honestly are answering that you know what direction a company is going to go, with all due respect, you're kidding yourself. Now, that doesn't mean that there's not information available to us that can help us make a more educated guess. And that's what we've got to do. We've got to get our hands on as much information as is available and pertinent to what we're trying to do to make the most educated guess we can possibly make. And isn't it easier to make an educated guess on a company that you know, and a company that you know something about, and a company that you have some familiarity with? If you know the companies you trade and you trade the companies that you know, you're one step ahead in the process when it comes to making that educated guess. I am going to recommend to everyone going through the Safe Option Strategies education that you create a watch list of companies that you know. It may start out small, it may start out a little bit bigger, and you might have to whittle it down. Ultimately, and we'll talk about this a little bit more, ultimately, we'll talk about a watch list of maybe, give or take a few, in the neighborhood of 20 companies. The way to create that list is to make sure that these are companies that are financially sound. And that ultimately is what fundamental analysis is finding companies that are financially sound. Every trade is a guess. Make it as educated a guess as you possibly can to give yourself the maximum advantage that you can give yourself in the market. Let's talk about a watch list. My recommendation for a watch list is this. Start out with 10 to 15 companies in at least 3 different sectors of the market. Don't pick 10 companies that are all tech giants. Don't pick 10 companies that are all retail companies. Don't choose 10 companies that are all energy sector or oil and gas companies. Pick a few companies from each of those sectors to start out with. And if you have 4 or 5 or 6 different sectors represented, that's absolutely fine. But make sure you mix up some sectors. Get companies that are in different parts of the economy or that are affected by different parts of the economy. Make sure they're companies you know a little bit about. And some things to know. When I say know a little bit about them, know a little bit more than the name of the company, the ticker symbol, and what the primary thing is that they do. Let me give you an example. Since the very first time I created a watch list, the Walt Disney Company was on my watch list. My family, we're a Disney family. We're one of these families that at least every couple of years we try and make a trip to Disneyland. We've been on a Disney cruise as a family. Some of our Halloween and Christmas decorations and springtime decorations have Disney characters. We're kind of one of those families. Not over the top, but we enjoy the parks and the characters and the movies and so forth. I also know that Disney owns ESPN and ABC. And even those two companies, while they are in a similar sector, have a different demographic that they cater to. Disney does a lot more than just theme parks and character movies. They're into other things. Disney may not have huge competitors when it comes to the theme parks. And you could certainly point to Universal Studios has they've made a pretty impressive run in terms of some theme parks in Orlando and in Southern California. Big shock there. Those are where the two biggest Disney parks are at. But other theme parks just kind of don't hold a candle to Disney. But ABC's competitors are NBC, which is a subsidiary of GE, I believe. CBS is a competitor to Disney because of the ABC affiliation. Fox Sports has created, and CBS Sports have created very large presence now that are rivaling and competing with ESPN. Why is that important to Disney stock? Because for the last several quarters, ESPN has been a little bit of a drag on the company. They're facing greater competition than they ever have in the history of that company. When ESPN started, I believe in 1979 or 1980, somewhere back in there, first of all, people thought they were crazy. A news channel that just did nothing but sports all the time? People thought that was crazy. And then they got huge. They became a behemoth, and they were the only show in town for a long time. Well, Fox Sports, CBS Sports, they're rivals now. They're competitors with ESPN, and they've taken away some market share from ESPN. And as a result, ESPN has been a little bit of a drag on the Disney company overall. Disney by itself, without the ABC ESPN entity, they make huge profits every quarter. They grow every quarter. They raise their prices every year. Their movies do, even when they occasionally come out with a dud, overall their movies do well. But ESPN has been a drag on that business and caused the stock to come down. These are things that are important to know. Know about the company's primary competitors. Make absolutely certain you know when their next earnings report is. Don't put a company on your watch list and lose track of when they report earnings. And I would recommend, in conjunction with this information about earnings, 4 times a year we have something in the U.S. markets called earnings season. The first earnings season every year starts around January 10th or 11th and goes through about February 12th, 13th, 14th. And then 1 quarter later, from the beginning of April to the early part of May, is the next earnings season. And then the next earnings season after that is the early part of July through the first week or two of August. And the last earnings season of each year is the early part of October to the first week and a half in November. Okay, those are the 4 earnings seasons. It is called earnings season because a large majority of the Fortune 500 companies that are publicly traded in this country report their earnings during that time period 4 times each year. There are companies, plenty of them, and some of them big name companies that report outside of the earnings season. When you're building this watch list of 10 to 15 companies, try not to have all of them reporting earnings in the same 2-week period of time or 3-week period of time. Give yourself other opportunities for trades. We have an entire class Coming up just a couple of classes after this, if you're going in order, we have an entire class devoted and dedicated to understanding earnings, the importance of earnings as it relates to our trades, as it relates to the companies, and so forth. So I'm not going to talk much more about that, but make sure when you're putting together a watch list that you have the earnings dates and that you have a good idea of when those are. Find a reliable source of news for each company. I like to go to finance.yahoo.com and just scan the most recent news headlines. Google Finance is another good site. Bloomberg is another good site. CNBC is a good site for news about a company. There are plenty of places where you can search for recent news on a company. This is one that I'm very familiar with, so I like it, so I use it a lot. And as you're building this watch list, study the past performance around major events like earnings report. Look for patterns. We like companies for our watch list. Well, I'm going to get into it in a minute. Let me continue to go in order here. Knowing the competitors. Is the company that you're going to put on your watch list, is it strong in its industry? Does it equally perform or outperform some of its competitors? That's good information to know. Is the sector overall strong? You don't want to get some little strange, obscure sector that may be gone in no time at all. I'm trying to think of I'm just blanking. I'm trying to think of a sector that may have existed that's just simply no longer around because of the way technology moves and advances and the way things improve in our society. But make sure you're dealing with sectors that are strong, and make sure you know how seasonal that sector is. Is the retail sector seasonal? You bet it is. Especially if you're trading companies that deal a lot with shopping, Christmas shopping type items. There are certain things that you can buy that are more seasonal around Christmas time than any other part of the year. Gadgets, devices, clothing, those are far more seasonal than a retail store that deals a lot with groceries. The groceries are going to be more consistent throughout the year. It's good to know how the company on your watch list is affected by the news and events of its competitors. Okay? Recently, at the time we're recording this live, Samsung has had an issue with a battery in one of its newest cell phones, and they've had to recall. First, they recalled a whole bunch of the phones and were replacing the batteries, and then they scrapped the entire phone. They're asking for a recall of it across the board. That cannot be anything but good for Apple, because the iPhone and the Samsung Galaxy phone are probably the two most common, widely used smartphones in existence right now. Is bad news for your company good news for one of its competitors, and vice versa? It's good information to know. Okay, the earnings date, here are a couple of websites. If you're listening to the recording or going back to the recording after listening to this live, you can just pause the screen here and write these down if you want to. There's a couple of good websites to find out earnings, and it's always a good idea to just go to a company's investor relations website. Type in any company. When you've got an open window on your browser, on your web browser, just type in Apple Investor Relations or Nike Investor Relations or Boeing Investor Relations, and you will be directed right to a website that has the most recent earnings information, has the most, a lot of times it will tell you when the next upcoming earnings is, but look at the last earnings date and assume the next one's going to be about 3 months out in time. Always know this information. This should be, for 10, 15, maybe as many as 20 companies, this should almost be information that you can just recall without having to look it up. You may have to go and look this information up on occasions, but you should have a pretty good idea of the companies on your watch list when their next earnings is. Now, be a little bit careful on this. It's good to know what the expectation is for the upcoming earnings, and what I mean by that is analyst expectations. It's a good idea to know what the analysts are thinking a company should do, because sometimes a company can perform quite well, but it comes up a little bit short of the expectation of analysts, and that can cause the stock to go down. Very recently, Amazon reported a quarterly earnings. Amazon has been on an incredible tear the last couple of years. They're a huge company. People talk about Amazon that they're taking over the world the way they used to talk about Costco or Walmart taking over the world. Now they're talking about Amazon taking over the world, facetiously, obviously. But Amazon reported, in my opinion, some pretty phenomenal numbers. It came up short by a few pennies a share of what the analysts' expectations were, and the stock has sold off from, I think, around $840 a share down to $770 or so, just in a matter of about a week. I think they even got down to maybe $765 or $766. That's just in a period of about a week. That's a pretty big drop. And it had to do with coming up short of what the analyst expectations were. It's good information to know. And then another good piece of information is, how much does the company move on a good or a bad earnings report? One of the things that every company on my watch list has in common is that the most likely thing to change the direction the stock is trading in, and the biggest up or down movements, usually come, not always, but usually come right after an earnings. Now, I always want to be careful and tell people, don't assume going into an earnings report that you know what's going to happen after, but isn't it better to know that if a big move or a change in direction is going to happen, you have a little bit of predictability of when it might happen? Don't assume that any company will only alter its direction the stock is trading, or have its biggest movements around earnings. There are other things that can and will happen. But if there's a consistent historical pattern, 3 out of every 4 earnings reports show the biggest movements up or down during the course of the year. Most often when the stock changes directions, it does so right after a good or a bad earnings report. When you see more history that confirms that, that's better for as far as being on your watch list. Okay, now, how do we look at some of this information? How do we find some of this information? One of my favorites is, and I'm not pitching this saying that you should use it. I'm just showing you what I use, and I like Yahoo Finance. And you know, honestly, I'm not a huge fan of the company Yahoo. I don't use Yahoo much outside of Yahoo Finance, but I like Yahoo Finance. I like the page. It's organized quite simply, and it's easy to navigate. And when you type in a ticker symbol in the search box on Yahoo Finance, and other websites are going to be similar, the first thing that comes up is a summary, and you get a snapshot. What's the range been that this company has traded in for the past year? And even today, if you want to know today's range. What's the average volume of shares they trade on any given day over the past 3 months? How much volume have they traded so far today? I might look at this typically towards the very end of the day. A quick snapshot of a quick glance at have they traded a lot of volume today, or are they really light on volume? Just below this, without having to type in anything else, I've just got one of them listed here, but there will be a list of the most recent articles, the most recent news. Some of those articles are from kind of obscure sources, and I ignore them. Or I might just read a little summary of them. A lot of times I'll click on those articles and see what news might be driving the company that I own or the company that I'm thinking about trading. Now, there's a lot of other information you can get from this and this is helpful. And you don't have to do this all the time on every company. If you do an initial analysis of these things when you're adding a company to your watch list, it may be one time every 6 months to a year that you'll go back and review this information again. And you might not even have to do it that often. But there's information you can get on the key statistics of the company, the most recent financials, and a historical comparison on the financials. Let's talk about a company being financially sound, because a large part of fundamental analysis, if we're paying attention to when earnings is, We're getting some different sectors. We're knowing what we can about the company in terms of what product or service it offers. Is it seasonal? Who's its competitors? How much do those competitors' price movements affect the stock? That's all a good starting. We want to know that these companies are fundamentally sound. Now, I've got a number of people, students of safe option strategies, who are accountants or they have some type of a financial background where their knowledge of finances is probably so much greater than mine that we couldn't even compare it. And on a couple of occasions, I've received emails or phone calls from them, and they said, Jeffrey, you're oversimplifying things. So let me state this very clearly. The example and the analogy I'm about to give you, I know is an oversimplification, but that doesn't mean it doesn't work to help emphasize the point. I want you to think about your own personal home or family budget. Think about how big is your mortgage? How big are your car loans? Do you have any credit card debt? Do you have anything else financed, a boat or a second home or whatever the case might be? Think about that. Think about how much money you have coming in each month or each quarter or each year. And think about whether or not you can quickly figure out if you're in good shape financially. Now, your definition of being in good shape could be a little bit different than my definition of being in good shape, but I think a lot of people would agree that if the amount of money you have coming in every month is more than what you need to pay all of your bills, you can take care of all of your debt payments, you can put food on the table, you can pay the electricity, the gas, you can have your internet, the things that you need, the things that we need to live today. If you've got all of that covered, you've got an additional amount left over for discretionary spending, and you've got enough left over that you're putting some into retirement or savings or whatever the case might be, or maybe you're at a stage in your life where there's extra money and every month you can travel a little bit. It's not hard to figure out at a snapshot glance if you're doing okay as far as meeting your obligations. If you're looking at a big company, and this, by the way, is a very recent income statement for Apple. That's the company we were on the previous page, so I'm sticking with Apple through these examples. This is last quarter's revenue. And that B right there for billion seems to cause us to forget how things work. And there's no need for that. It doesn't need to. Forget about the B on there. Pretend it's not there. Pretend for a minute that's there. Pretend this is $215,000. If you and do the same with every one of these numbers that has this B behind it for billion, and just think about this. If I had $215,000 coming in, and this is a quarterly number, let's talk about it on an annual basis. If I had $215,000 coming in annually, I had $67,000, almost $68,000 in the bank. And all of my debt, everything, what I have left to pay for on my home, my cars, whatever, all of my debt added up to a total of $87,000. Well, I've almost got enough cash to pay off my debt, and I certainly have more than enough money coming in to manage and take care of whatever payments might go with that debt. Now, I know there's a lot more to it. Again, this is for my students who are accountants and who are economic professors and who deal in the world of finance all the time. I know there's way more to it than that. I know a big company like Apple has such a complex balance sheet and all the intricacies of it. But conceptually speaking, is it hard to look at something like this and make a determination that financially this is a pretty sound company? Does anybody look at this and think that this is not a pretty sound financial company? $215 billion in revenue coming in a quarter, and the total debt they have is $87 billion, and they have almost enough cash on hand that they could wipe out their debt if they chose to? That's a pretty sound company financially. There's more that can go into it. I forgot I had these circled. There's more that can go into it. How are they doing year over year? Well, for the very first time in the third quarter of the 2 previous years to the third quarter of the most recent year, Apple went down a little bit in revenue and in income. That hasn't happened in a long time for this company. Now, did they still make a tremendous amount of revenue? Yeah, they did. And notice this says all numbers in thousands, so this is 215 billion in revenue. That's a huge amount of money. That's a grotesquely huge amount of money. 84 billion in profit, but it's down a little bit from where it was last year versus having a lot of history of going up from one year to the next. That's important to know. If this trend continues for a couple more quarters or for another year or two, then we might have some questions about this company and whether they should stay on our watch list. By next year at this time, this might look like a one-off. It might look at the one anomalous year in the last 10 or 12 years that the company didn't make. Now, it still made a lot of money and a lot of profit. I don't think they're hurting on $84 billion in profit. Just not as much as they did in the same quarter the year before. It's not a bad idea to know who's steering this ship. Who's at the wheel? Big companies from time to time change their CEOs. It's not a bad idea to know a little bit about these people, a little bit about their background, and a little bit about what they might bring to a company if there's a shakeup in the high up management of a company. Not too long ago, I think it was 6 months ago, two quarters ago, Under Armour, most of you are familiar with who Under Armour, probably the biggest competitor head-to-head right now with Nike. Under Armour lost one of their key executives. He was their chief purchasing officer. This was the guy that was in charge of all of their buying of all of the different components that go into making their shoes and their apparel and all this different stuff. And he left the company, and he left the company under a little bit of a dubious cloud. It wasn't a friendly parting. And as a result of this, the stock price took a major hit. People were worried about the supply chain. Is Under Armour going to keep getting the leather and the other fabrics that it uses, and the rubber and the shoelaces and the material for the different clothing? And are they going to keep getting this stuff at a good price? Or are the connections from this chief purchasing officer going to go out the door with him? It's not bad. And again, this is something you might look up initially when you're putting together your watch list the first time. And you may not go back and revisit any of this unless you read a headline that says Bruce Sewell of Apple is stepping down and retiring. It might not be a bad idea that a guy with a $5 million salary, that you know who's going to take his place. It's not bad information to know. Some very helpful links. So let me. We're already close to summarizing this. This isn't a real long class as far as our classes go. These are some helpful links for doing the analysis you're going to do. I'll put these on the page and I'll leave them up here for a little bit. These are a handful of websites that I like, and I use this website probably as much as any other website I use for my fundamental analysis. This is a little bit more for technical analysis. We spent some time in the previous class going over stockcharts.com, and we'll talk about it a little bit more in our next class, which is technical analysis. But even on stock charts, you can see some information about average daily volume and some of the recent moves, and have a better feel for whether a company is fundamentally sound or not. But these are some good sources of information. I'm leaving this on here for a minute, so if you want to write these down, go back to the recording later and just pause it here if you want to write these down. Whether you're trading bullish or bearish, whether you're looking to profit from upward or downward movement, stay away from companies that are not fundamentally sound. That's really what fundamental analysis comes down to. Look for companies that are sound. Look for companies that aren't at real major risk. Anything can happen to any company at any time, but look for companies that aren't at a major risk of disappearing. Don't trade companies you don't like. I trade Smith & Wesson. I have students, and I love that they have the right to this opinion, even though I disagree with them. I have students that are so anti-gun that gun ownership, they can't stand that I trade Smith & Wesson. Bothers them. I get an email from them from time to time. Bugs them that I trade Smith & Wesson. If you don't like Smith & Wesson, if you're not a gun person, don't trade them. I have other students that are, I don't want to say they're anti-green energy, but they might have some issues with how much the government is involved in subsidizing green energy companies. There was a little bit of a scandal. I don't know if it's a scandal. There were some headlines a while back on how much government subsidies some solar company was getting, and it was kind of a ridiculous amount considering they had so much government money, which is our money. Government money is our money. It's taxpayer money. And they went under, they filed bankruptcy or something, and this goes back a few years, I believe. But I have students that won't trade green energy companies, solar companies, and other companies like that, because I don't think they don't believe it's good for the environment and wouldn't like to see them do well. They don't like the government involvement in it. I trade First Solar. I've got students that don't like that I trade Smith & Wesson. I've got students that don't like that I trade First Solar. And I tell them all the same thing every time. If you don't like a company, don't trade it. You don't have to trade companies you don't like. Start the watch list small. This is my recommendation. Start it out kind of small and add to it over time. Build it up. If your personal bandwidth allows you to keep track accurately of 25 to 30 companies, have a watch list of 25 to 30 companies. If you're and by personal bandwidth, I mean how much time can you really give it? How much time do you want to spend reading articles at the close of the market or the next morning before the market opens to make sure you're up to date on the latest news on the companies you trade? Never, ever underestimate the value of due diligence. Everything we are doing in the market, every move we make is an educated guess. Make those guesses as educated as you possibly can, and you'll be better off for it. And that wraps up our fundamental analysis class. Thank you, everybody. Have a great day. Bye-bye.